Good afternoon, everyone. My name is Aditya Muralidhar. I'm an associate partner at Bain & Company, and I work in our financial investors practice. I'm thrilled to share with you the key insights from our upcoming private equity and venture capital reports. A sneak peek, if you may. These are our yearly publications that delve into the events in the past year in the landscape, examine the emerging trends in the field, and also offer some insights on what lies ahead in the upcoming years. So over the next 15 odd minutes, I'll start by examining the investment activity that we saw both in the private equity as well as the venture capital landscapes in India. I'll follow that up by talking about the fundraising activity and what that revealed about the investor sentiment. And finally, I'll briefly touch upon how investors approach exits and what key themes stood out over there. So in 2023, about $39 billion worth of funding were deployed in the Indian market. This was about 35% to 40% lower than what we saw in 2022. This was a reversion to the pre-COVID levels of investment and was primarily driven by a weak macroeconomic sentiment, persistently high rates, and just buyer-seller mismatches in valuation expectations. But that said, despite this compression that the ecosystem saw, India maintained its status as the second largest funding destination in Asia Pacific. Now, looking at the deal flow a little bit more closely, private equity deal flow comprised about 3/4 of the total and showed more resilience compared to venture capital investments. To put this in perspective, private equity deal flow shrank by about 20% over 22-23, but in contrast, venture capital investments saw a much sharper decline by about 60% over the same time period. I will throw a spotlight on the venture capital and growth equity investment subsequently, right after I touch upon the overall landscape key messages. So the ecosystem fundamentally was impacted by diminished deal making, and there are a couple of key factors that drove this. Firstly, the macroeconomic challenges prevented companies from demonstrating the levels of performance that investors sought. And secondly, lagging valuation corrections also meant that there was a mismatch in the valuation expectations between the buyers and sellers, which further impacted deal closures. I'll stay on the same slide and just talk a little bit about our observations from a sectoral view. Traditional sectors, so I'm referring to consumer retail, healthcare, manufacturing, showed more resilience over 22-23 compared to new age and tech-first sectors. I'll take a few examples here. Consumer retail and healthcare saw buoyant deal flow, increasing over 80% and 30% respectively. Now, in consumer retail, of course, the mega Reliance retail deal did offer some uplift to the investment activity. However, if you look at the momentum, it was underscored by a positive outlook on just consumption recovery happening, longer-term income growth, as well as just organization trends in the sector. In healthcare, investments reached a record $5.5 billion, primarily driven by provider deals. Now, before I jump into the new age sectors and the tech-first sectors, I'll hit upon the key messages on the venture capital and growth equity funding. So as I mentioned, in comparison with private equity deal flow, venture capital and growth equity investments saw greater impact and totaled about $9.5 billion in 2023. This was about a third of the levels that we saw in 2022. Deal volumes halved in venture capital and growth equity, and this was primarily driven by investors deploying capital more cautiously, more selectively. But we also saw several scale, well-funded, well-capitalized startups deferring their fundraising in a valuation challenged environment. What that drove was greater compression in later stage deals, while early stage seed deals stayed more resilient. And interestingly and importantly, in 2023, we saw the continued participation of family offices, corporate venture capitals who provided critical early stage capital in an objectively tight funding environment. Again, I'll stay on the same page as I talk about some of the sectoral trends here. Now, consumer tech, fintech, and SaaS continue to attract the majority of the VC and growth equity funding, but each of these key sectors witnessed sharp declines in funding. To take an example, consumer tech as well as software and SaaS saw 70% declines in their funding over the year, and this was driven by investors continuing to maintain strict thresholds on performance that they expected from their companies, looking for robust unit economics and paths to profitability, while on the other side, these well-capitalized scale startups deferred their fundraising, focused on managing their burn and extending their runways. However, amidst these declines across key sectors, there were green shoot sectors that displayed resilience and promise for the year ahead. I'll cover a couple of them in a bit of detail today. The first being generative AI, which is all the buzz. Generative AI investments surged 17x on a small base to amount to approximately $250 million in 2023. This was primarily directed towards generative AI apps. I'm talking about software platforms that incorporate generative AI capabilities in their core proposition and functionalities. Even looking ahead, the Indian generative AI landscape is expected to be dominated by applications, given we are seeing very convincing early signs of strong development activity. And secondly, India has a very deep talent pool that innately understands software and tech workflows, given our legacy in this domain. Now, looking at electric mobility, the second green shoot sector I wanted to highlight, the sector attracted, or the ecosystem attracted about $600 million in funding, just a notch lower than what we saw in 2022. This decline was primarily seen in EV OEM segment, which saw headwinds due to uncertainty on the FAME subsidies outlook. But that said, the growing investor sentiment in this ecosystem was evident across the other core value chain segments. So for example, if you look at batteries or charging or auto components, there were sizable jumps in funding. Even looking beyond the core value chain at segments like EV battery recycling or EV financing, 2023 saw deals being struck. Taking a longer term outlook, it looks positive for the ecosystem as it's well poised to unlock a $100 billion revenue pool by 2030. Structural commercial tailwinds are expected to continue. For example, introduction of affordable EV options, deepening of charging infrastructure, distribution to non-metro locations, and exit prospects via strategic deals is expected to remain strong. Now, taking a step back, the VC ecosystem was buffeted by several challenges, but what we observed was stakeholders adapting to these shifts and to the apparent new normals. I'll talk through a few examples across stakeholders. So if I look at investors, there was a perceivable shift in investment paradigm to more traditional sectors, and selectively these were sectors that had the benefit of strong consumption headroom along with strong formalization trends, along with strong tech enablers. Investors also drove a step shift in governance in 2023, bolstering the governance rails across the deal life cycle. Now, if I look at regulators, regulators continue to push on digital infrastructure, both to drive product innovation as well as ease of doing business. Regulators also establish standards to drive green shoot sector growth. A good example here would be BIS approving the combined AC/DC charging connector standard for LEVs, which is expected to drive adoption in the longer term. And finally, startups visibly hunkered down on profitability, with several notable startups across sectors announcing that they turned green in 2023. But amidst this tightening of belts, we also saw continued investments in deep tech innovations in areas such as generative AI infrastructure, climate tech, space tech, and aerospace as well. Now, I'll shift gears to fundraising. 2023 saw robust fundraising activity both on the private equity as well as venture capital sides. I'll take them one by one. Starting with private equity, domestic GPs raised about $2.5 billion in 2023, which is broadly in line with what we saw in 2021 and 2022. And importantly, this level of fundraising is a notch above what we have seen in previous periods. Interestingly, several leading homegrown GPs announced that their next fundraise will be 30 to 50% higher than what their previous largest fundraise was, demonstrating optimism in the ecosystem. Global GPs also demonstrated very similar optimism, with several recently indicating that they're looking to increase their rate and quantum of deployment in the Indian market. Shifting to the VC growth equity side, $4 billion were raised in 2023. And if you take a longer view and not to be biased by the 2022 watershed year of $8 billion of raising, it is probably one of the highest that the ecosystem has seen. The interesting part is when you actually look under the $4 billion, 90% of the funds raised were by domestic or India-focused GPs. A quarter of this were maiden funds, and there were several thematic funds focused on emergent themes such as sustainability and climate tech that came up in 2023. All of these are extremely strong indicators of the deepening of the ecosystem as well as the persistent optimism in the market. And finally, Exits in 2023 remained buoyant, amounting to approximately $28 billion as GPs sought to return liquidity to their LPs. While the value increased by about 15%, there was a step increase in the total exit volumes, which reached about 335, which is a record high for the market, soaring 60% over the last year. Public market exits were the majority mode of exits for the investors. And even within that, it was primarily driven by the trade of listed securities as opposed to IPOs. And IPOs were a minority, quite similar to what we saw in 2022. And interestingly, the surge in exits was primarily seen in new age tech sectors such as consumer tech and SaaS. And a lot of the large exits in these domains were led by crossover funds who had previously focused their investments in these spaces. And with these sneak peeks into our upcoming report, I will conclude my presentation. The venture capital report is due to be launched mid-March and the private equity report mid-May, and both of them will contain a lot more details on the topic that I touched upon today. And I'm eager to keep the conversation going. So if you have any questions, do feel free to reach out. My name is Atya Muralidhar. Thank you so much.